What's up, traders? Anthony Crudele here, and thank you so much for tuning in to the Futures Radio Show podcast. In today's show, we're going to go over the different futures and options products that CME Group offers for futures traders. We're going to talk about the growth of futures coming from retail traders. And with all of the zero DTE craze, do we have zero DTE options on futures? And we'll do a quick summary on how to use CME Group's FedWatch tool to show you what the market thinks about future rate hikes or cuts. Today, my guest to discuss all of this is Tim McCourt, the global head of financial products at CME Group. Today's podcast is brought to you by CME Group. Whatever the obstacles, CME Group provides the tools that global market participants need to manage risk and capture opportunities. With 24-hour access to futures, options, cash, and OTC products across all major asset classes, you can drive your trading strategy forward with confidence and precision. CME Group, where risk meets opportunity. Tim, welcome back to the show, my friend.
Hey Anthony, how's it going?
I'm doing great. Tim, obviously you and I have been doing this together a long time, talking about futures markets. We're constantly on the show together, talking about updates. And we've done shows on really all these individual things that we're going to talk about today. But what I want to do is I want to actually take a step back because the growth that I'm seeing in the futures industry right now is pretty incredible. And we're seeing so many new traders come to the podcast asking me to talk more about futures, what different product choices they have. And although I could send them to all these videos, what I wanted to do for all the new traders out there coming into futures is go over really an overview of everything that CME Group offers for futures and options on futures traders. And so, Tim, one of the things that I want to start off with is just the product availability. You and I remember when we talked about the launch of micros, we talked about the launch of micro options, then daily micro options, right? Or weekly. So there's just more and more things coming to help traders choose the best tool that works for them and their strategy. So I think maybe we start off today with the different options that traders have when it comes to coming into futures and options at CME Group.
Great. Yeah. So when we look at CME Group, I think the one thing that's important for everyone to remember is that here at CME Group, whether you're looking to manage risk or to access the markets, we have all the six major investable asset classes across financial products, which are equity, foreign exchange, interest rates. And then on the commodity side, we have agricultural products, energy products, metals products, and we have cryptocurrency. Still whether open question whether or not that's the seventh asset class. I don't know if it's been promoted to the seventh asset class yet, but it's certainly a growing complex here at CME. A lot of traders trading all sort of size contracts, whether it's things like the E-Mini, the micros, options. We recently launched event contracts, lots of also different size contracts. So there's really something for everybody that fits your portfolio. And if people aren't involved at CME, I can't encourage people enough to check it out and use futures in their trading strategies and in their portfolios.
Yeah, I think that when you get new people to futures trading, they look at really probably the E-Mini S&P to start off, but then they don't really realize that you have micro treasuries. You can actually trade the yields in the 2, 5, 10, and 30 year. You can trade 10-year. You could trade 10-year ultras. You could trade 30-year, 5-year, 2-year. You could trade gold, silver, or copper, platinum, and all the softs. Think about corn, wheat, all of these different products. And I think that when you are new to futures, it's so important to really find your niche in which products that you want to trade, especially if you're just trading price action, which probably most of these people are. They're not going to take physical delivery versus cash settlement. And I think maybe that's the next thing we really talk about is the understanding of that, because I don't think that a lot of people even understand that there's the physical delivery behind crude oil, behind gold. If you're actually a big player in the space and you want to take delivery, you're going to the futures markets. Explain how that works, Tim.
Yeah, so it's really interesting when you think about the sort of fundamental features of the future. It's you're agreeing to buy that commodity at a future date and time at a set price that you established today. and it converges to that delivery. So whether it's a bushel of corn or a bushel of soybean or oil or gold, it's really the physical underlying commodity that you're taking possession of or you're making delivery of. And that's really at what at its core makes it a hedge vehicle. If you're a farmer and you're planting to today and you want to lock into that crop price at the end of the growing season, you can use futures to manage against that risk. But when you look at sort of how the markets have evolved over time, and if you look at the financial products, like Anthony, you said the E-Mini S&P 500, that's just moving U.S. dollars. That's the settlement feature, just moving U.S. dollars against the price of the S&P 500 index. But when you look at it, then you have other sort of contracts and products in the portfolio. And when you go into expiration, it's a great way to trade these products, right? You don't necessarily need to be that farmer to trade corn, or you don't necessarily need to be an equity asset manager to trade the S&P 500. To your point, when you look at all sort of the products and understand what you're trading, then you can look at, I use the word a lot, personality of the contract. If you're looking for a contract that moves a lot during the day because you want to sort of scale in and scale out of the product. If you're looking for something more as a proxy for an investment or an access product, you can trade the E-mini S&P 500 and then roll it every quarter, right? It's very easy to use it as an investment vehicle, as a trading vehicle, or as a hedge vehicle, right? And what I mean by that, on a hedge vehicle, think about it, even if you're an avid stock trader, right? And you may be thinking about or contemplating getting into futures. If you have a stock portfolio and maybe you don't like where the market's going, you think it might be selling off a little bit, you don't need to liquidate all those holdings and create the tax events for you. Just sell maybe some micro S&P or micro NASDAQs or even micro Russell, right? Sort of depending on what the composition of that stock holding is. And you can protect yourself against those market moves without having to liquidate the stocks you hold. So it's not an either or choice that I'm just a futures trader. You could feather them into your portfolio. You could use them as hedge. You could start, using them. You could learn more about them. It's really a powerful tool both for trading and risk management. And it's something that we're constantly hearing from listeners and viewers of your show, and all the new participants are getting to the market. Is that once they're in, they're sort of shocked it took them this long to get started with future. They're like, why did I start this sooner? And you're like, well, Anthony and we've been in the show for a long time. We've always been telling you to get started.
Exactly. You know what? One thing I want to talk about is really the difference between a physical settlement and a cash settlement. When you're buying the S&P, that's a cash settled product. When you're buying crude oil, it's physically settled, except for the micros. So there's also differences in the size of the products, and some of them are physical when you get into commodities, and some of them are financial. But I just want to touch really quick on, let's just say that you're somebody who bought the S&P and you never covered it, and it goes to settlement. How does that work at settlement?
Yeah, so if you look at the E-mini S&P 500, and it largely works the same for all of our equity index contracts, on that third Friday in the March, June, September, and December months, those are the quarterly contract months for the equity index. On that third Friday, the SOQ, which stands for the special opening quotation, is the index level average of all the market on open prints of all of the individual component stocks. And you get an index level, and that's where you settle it to. So if you bought it, very simply, if you bought it at 100 and then on final settlement, it's 102, that's a $2 P&L if you were long, positive two. And then you're posting initial margin when you put that trade on, you're posting variation margin every day into your account. So it's along the way, it's not so much that you may have to pay all that settlement on final settle because you've already been paying variation margin. So on that final settlement date, it's really just even the 1 day change of your position if you think about it like that. But then you can have that cash in your account, and you could choose to roll it in advance if you want to sort of avoid the final settlement and keep your exposure continuous. Or if that was it and you just want to let it naturally come off the board, so to speak, or expire, then that's it. Just final settle against the good old cold hard cash of US dollar.
Thank you for sharing that, Tim, because I get that question a lot by new people. They're like, well, like if I have the SPY, it never expires. But if I have the E-mini S&P and it doesn't expire, and your broker most likely is going to tell you, look, this is getting ready to expire. Just understand that, how it actually works. So I appreciate that. And next thing I want to get into is, and I'll share these links, everybody, they'll be in the description. If you're listening to this on audio, they'll also be in the description. The first link that we're going to go over here is really just the micro suite of products. I mean, Tim, when you and I first came on and started talking about this, we knew that this was going to be massive, right? We
Yeah.
we knew it because there was so much demand for all of these products anyway. And then when you added a micro, we knew that there was going to be a lot of smaller traders or just more precise way to hedge for even bigger traders using a micro. Explain to everybody the differences between the bigger products, which a lot of them are just going to be called E-Mini products, because which in some ways, I think to new people, they still think it's a smaller product, but it actually is the full size versus the micro.
That's right. So if we look at the micro size contracts, most of them are 1/10 the size of their older sibling contract. So if we look at the E-Mini S&P 500, that contract's been around for decades. That has a multiplier of 50 US dollars. So the value of that contract is the index price times 50. If you look at the micro, the multiplier is $5, 1/10 the size. Makes it much more sort of approachable in your account from a risk perspective. You could scale up or scale down throughout the trading session, but all other features work the same. It settles against that same price I was just talking about. The E-Mini and the Micro E-Mini, they share the same settlement price. They have the same listing cycle. They have options on them. So anything you can do sort of in the larger E-Mini contract, you could do in the micro contracts as well. And that's a theme across the board is it really is offering this more precise risk management tool or a very easy way to access the market in a more granular fashion with not as much capital outlay. If Even if you're in the E-Mini, but say maybe you want to start trading in energy, trade micro crude, right? It's a great way to learn more about that market and how it functions and try out some new strategies. So it's really a powerful tool. And what's wild to think is we really got the micro complex going back in May of 2019 when we launched the micro E-Minis. And since then, over 2 billion micro contracts have traded at CME. So just in a handful of years, I mean, that's quite impressive.
It's crazy. And I was actually looking at some of the stats, and it said the average daily volume in the micro E-Mini futures suite reached 2.7 million contracts in Q1 of this year, which is crazy. And I actually want to talk a little bit about how much the Nasdaq has gained on that. I think this is an important thing because you see how when you add a micro to some of these products, everyone knows the E-Mini is really the E-Mini S&P, I should say, is really just the big boy because it's the S&P 500. But when you get into the micros, the Nasdaq seems to maybe edge it out in its growth.
That's right. What's interesting is I think it actually might have been in Q1, might have been the first time in almost 2 years where I think the micro S&P might have clawed back to the top spot over NASDAQ in terms of the micro tradings. But the micro NASDAQ has been way more popular on sort of a proportionate basis when you look at the micros, how they trade versus the E-minis. To your point, the S&P E-mini is trading 2 million a day, where maybe NASDAQ E-mini is trading 600, 700,000 contracts a day on average, right? But if you look at the micros, you have sort of about 1.1, 1.2 million contracts in both of them. They're very close. They're trading sort of in line with each other, and I think that speaks to for the Nasdaq, it's the popularity of some of those stocks. When you think about the top names of the Nasdaq, it really is things that we're all familiar with in our everyday lives. We're using these throughout the day. We're using the products by these companies throughout the day. So there's much more familiarity. And you think about some of the new participants that if they're already trading stocks, they're probably heavily active in the NASDAQ name. They're embracing the micro NASDAQ when they come over to the futures market. So I think that's something where it's really just an extension of the popularity of some of those names. And we've seen that in other parts of the market. This isn't just a futures phenomenon. You look at some of the ETF trading out there, some of the single stock trading. NASDAQ has certainly been very active the last few years. And I think the smaller size contract that appeals more to that active individual trader is certainly what has given the Nasdaq, a chance of becoming the pole position or holding the pole position for almost 2 years in the micro suite.
Yeah, what I think that most traders recognize about it is that when you trade in a product like the Nasdaq, where it's as volatile as it is, you are less price sensitive with a micro. So you might be trading the same overall position size when you get 10 micros into one NASDAQ, but instead of being one NASDAQ in at one price, you might be 10 micros scattered across, 5 to 10 prices, and
Yep.
you're scaling in. I think that is the biggest thing that I have noticed with the micro Nasdaq, which is a product that I use regularly. And see, I don't use the micro E-Mini S&P really, but I use the bigger E-Mini S&P. But I love the Nasdaq because of what I said. I don't have to be as price sensitive, and I think it's extremely important for traders to really understand. That's why CME puts these products out there, because you can get more precise with position sizing, hedging, and all those different things. I also want to talk about when you get into the micro options. Now, what products have micro options?
So when we look at it in the equity complex, we have micro S&P and micro Nasdaq options. I think there's a few other micro options that have been rolled out across the board. The challenge is when we look at option markets, we don't have options on all of the micro futures because it takes a while to build option markets. Kind of curating option liquidity takes a little bit more. You need a little bit more robustness in the futures market itself to support that option. So right now in the equity complex, even though we have the four sort of major micro E-minis, and we recently added the 600 and 400 S&P, the mid cap and small cap, we're only really focusing right now on the micro Nasdaq and micro S&P options, trying to get those markets going, and it's going pretty well. We're seeing more and more participants turn to those markets, which is great. And it's another great tool to use. Works the same way as the E-mini options, which has been great. When you look at the option growth at CME, we're doing 1.2 million option contracts a day in the S&P E-minis. So that same liquidity, the same market makers, they're all leaning on that market to provide the micro liquidity. So you're seeing sort of the same price formations, the same quotes, the same bids and offers, but again, just smaller contract and an easier way to trade the market.
Yeah, I think it's such an important ad that CME had because of the growth of the SPY 0 DTE. We know how this has really just become just a craze in so many ways, right? There's so many people trading these 0 DTEs. And when you look at the future side, what I think is great about adding it as a competitor to that, and because I think it's a much better product, you don't have pattern day trader. You actually get the tax benefit with the futures, right? And you're really tied to the actual product as well, versus like tied to the SPY, which is really, yes, it's the ETF of the S&P, but this is the big game, right? The big game is the S&P 500 futures. And then when you take it down to the micros, you're still trading the S&P 500 futures, but just in a smaller size. And I think that's the one thing I just wanted you maybe explain, like on the option side, just how that works. It's just really a difference of dollar amount in terms of tick value, right?
That's right. So when you think about the options on a future, it's as the name suggests, it's an option on the actual future. So a way to think about it is sort of a physically settled option. You're going to make or take delivery of the underlying future for the in the money option positions at expiration. So because of that, it sort of inherits, for lack of a better word, all of the features of that future. So if you're trading an option on the E-mini S&P 500 future, the multiplier is effectively 50 trades and quarters, right? You see the same tick sizes. Same thing when you go to the micro size, it's now a option on the micro E-mini future with that multiplier of $5, right? But all the other features are the same tick size, same strikes, same expirations. So it's really just a option on that smaller future. But to your point, Anthony, the one thing that I don't think people understand is when you think about the totality of the equity ecosystem, the E-mini S&P 500 futures is the anchor of price discovery for all of those products, whether it's ETFs, whether they're cash index options or options on future. It's all on the E-mini. That is what drives the price formation and leads the way even for cash equities, right? A lot of the time. So the fact that you have an option on that future that is the center of price discovery is a very useful risk management and trading tool, that it has that gravity of being tied on the instrument, whether it's micro or the E-mini, same sort of market structure, same price action, settles to the same price, same listings, right? Same tick size, all these things. It's just, do you want the $50 version or the $5 version? And that's what I think people don't always understand. Like, oh, I'll just trade the ETF options, or I'll just do this. But like, that's like a I don't know, like a copy of a copy, right? When you think about it, right? Versus the being the center of the price discovery and trading the instrument that's driving that price formation in the market.
Ask any big hedge fund manager that talks about the S&P 500, and they'll tell you that the big game is in the futures markets. This is the product. And it's extremely important also to note that, as what Tim just said, instead of just having one single tick value in the SPY options, you have multiple choices here. You have the E-minis and you have the micros. So some days you want to be smaller, some days you want to be bigger. You have the same product and you've got two choices pinned to the real product, in terms of how big of a contract you want to trade. I also think that that's just really a big thing. And actually, I want to segue into something that I have spent a lot of time on, with my Place Your Trades network. And I've developed a whole network talking about micros and event contracts. And, with event contracts, this is the true zero DTE, isn't it, Tim?
Yeah, exactly. The actual, same day action, right? That you're going to see that in event contracts. That's right.
And so explain to everybody what an event contract is, how it works.
Yeah, so an event contract is a way to express a view on the markets at CME with a fixed amount of risk. It's really thinking about, is the E-Mini S&P 500 going to be above X price today? Yes or no? Will the settle price be above that? And that's the way, is when you sort of see the screen that Anthony's showing you. It's, if you think it's going to be above, you buy the yes, for 1875, and then if you're right, you get a $20 payout. It's a fixed payout, so you know what you're purchasing the event contract for, and you know what the maximum payout is. So it's a known risk profile of, the most you could lose is what you pay, and the most you could earn on that trade is 20, right? That's the payout if the event is sort of finishing in the money, so to speak. Now, what's interesting is why Anthony and I were sort of saying it's the true zero DTE, because these are listed every day, same day. When you're thinking about some of the other same day expiring options, they've been out there for weeks. We have 5 weeks of S&P options on futures here at CME. So that's, the next 25 trading days, we have those options, and they walk into same day today. They have their different sort of open interest profiles, but with event contracts, it's goes off the board at 4 p.m. Eastern, effectively, when the future settles, and then you're going to get the next one for tomorrow based on tomorrow's price. So it's really an interesting way to express your views on today's market activity throughout the day. And as you can see up there, we have it on a few different asset classes: equities, energies, FX, gold. So lots of interesting ways to get involved in the markets from a different perspective, with a much smaller known fixed risk profile.
Yep, fixed risk, fixed reward as well. But what also is interesting is that this is actually a third choice for an option, right? Because we talked about how you have the micro E-minis, you have the E-minis, and you have the options for both products. Here's another way to get in and to trade these contracts, and it fit your risk profile, right? I mean, that to me is, once again, very important. And this is pinned to the big game, the big product. And I think that this product is great for new people wanting to learn about futures and actually wanting to learn about options as well. And so I think that this is really the pathway to, I think, some of these other products, but also they're a product like someone like myself who uses from time to time, to where I just want to be directionally biased. And I think that there's an opportunity for a volatile day. And I think we're going to close above or below a certain area. And I want the fixed risk and I want the fixed reward, because I just want to just do it and leave it. And so they have their place as just another tool for traders, from beginners to advanced traders, to come in and trade these products. Um, Another thing I want to go to next is select sectors. I don't think that there's enough talk about this, Tim, because we just got done talking about the majors. And I think that's the one thing that, even you and I, on this show, we're always talking about a lot of times the majors and new things for the products. We're talking about S&P, gold, oil, all the things that everybody knows and can relate to very easily. But I think these sector products have a lot to offer to a lot of traders, especially traders that are coming from the stock side, because a lot of them are used to trading sectors. And so explain to everybody what CME Group offers with these sector futures.
Yeah, absolutely. It's a great product. It's been around for a long time at the exchange and continues to grow, doing almost 20,000 contracts a day across all of the sectors. And when you think about the sectors, the way I would describe it is think about, as Anthony said, yeah, the S&P 500. That's sort of divvied up into almost about a dozen sectors, whether it's financials, healthcare, consumer staples, consumer discretionary, all of these sort of sub segments and sectors, as the name would suggest, of the economy. So if you think financials are going to outperform healthcare, you could put that trade on by going long the financial select sector future and short the healthcare future. Now, the other thing that I'll say is really exciting about these products is, if you're already trading the ETFs, these are a lot of these track the very popular XL ETFs that are out there, but they're all the benefits of the future. So it's blended tax treatment for 60/40, short term, long term, blended rate. So when you think about it, it's one line item on your broker statement in terms of cost basis. You don't need a short locate code to short them. And they're available nearly 24 hours a day, right, on CME. So these are, if you're already trading the ETFs, I don't know why you're not trading sector futures. I mean, that's the crazy thing, because it's such a better product for your portfolio. When you think about the capital efficiencies, the initial margin, they function the same way like the other equity index contracts, financially settled. So it's a really great product. And over the last few months, we've even added more sectors. So I think we're up to just under 20 sectors sort of across the board. We added one for the Philex Semiconductor Index with our, from the NASDAQ index family. We sort of rolled out some of the banking and financial services and insurance ones. So you think about it, there's a regional banks one, right? There's lots of sort of these sectors in the market that you can express different types of views as a function of these sectors. So it's really great. It's a very useful tool, especially even think about it where even if you have the E-Mini, you could do sort of long E-Mini and maybe sell the financial if you want to underweight financials a little bit. They're really a great, powerful tool that can be combined to express your view on the market.
100% agree with you. I mean, look at this market that we have this year with tech leading, and you've got all of these ebbs and flows of different sectors. And the market, in a lot of ways, is just kind of just grinding straight up like it is in the Nasdaq and the S&P. But then you've got the Dow and the Russell that are struggling a little bit, and you can actually hone in on those sectors, and it allows you to have a stronger hand in the market. If you want to just be long the futures and maybe offset with some of these, and when I say long in the futures, maybe long the S&P or Nasdaq or whichever ones you choose, you can offset that or actually add to your position without actually adding to more futures of the S&P or Nasdaq by adding it to this. And so it just depends on what your thought process is. But I think that these are a product, and you nailed it when you said capital efficiencies. I would be very surprised to see more and more people not to catch on to this. Uh, I just think that these products make so much more sense.
That's right. And a lot of these sectors have margin offsets against each other. So you can even get better savings if you're doing long short. So they have offsets against the parent indices. So it's a really great tool for your portfolio, and definitely encourage everyone to check them out.
Last thing I want to discuss today, Tim, is the CME Group Fed Watch tool. Everybody, we're just coming out of, at least I think we're coming out of a rate hike environment. And I say that because number one, we never know. But what I do know is that what the market is telling us is that we probably are coming out of a potential Fed rate hike scenario. And how I know that is by going to the CME Group Fed Watch tool. And Tim, explain to everybody what's behind this tool and how it actually determines what these percentages would be.
Yeah, it's a great question. So the way I encourage people to think about this tool and why the market really and people love it is because it's really driven from the price discovery spot process of tradable products, right? So if you look at the Fed fund futures at CME, it's using that information of how people are trading those futures to assess and assign what the probability of the Fed, the FOMC target rate is at a certain point in time. So it's market driven. This is what the market thinks or this is what is being signaled that the market thinks will happen based on where people are putting risk on or taking risk off in the market. So it's really accurate when you think about it. This is what the market thinks right now. And whether it's right in the future, TBD, but it's right now. This is what the market thinks, and it's really powerful. And if you kind of scroll across, it'll give you the different FOMC meeting dates. So you can see, like, if you look at the first tab and the second tab, the market sort of right now thinks largely there's going to be no change at the next meetings. But you go out towards September, and then you see the picture looks different. So now maybe some people think it's going up, some people think it might be a cut. The market is saying maybe it's still unchanged. And then you sort of go further out to November and December, and you're going to see different probabilities where the market thinks, we're going to see some rate cuts in the not so distant future. So that's why I think it's really an informative tool. But the way I encourage people to use it is look at some of the historical, look at it day over day. It's really the trend, I think, that is also more important than maybe the discrete probability you're consuming. If it's 51% today and change, what was it yesterday? What will it be next week? Is the market getting more or less resolute? And this is the outlook for that time period. So I think it's a very useful tool. The more you get comfortable with it, the more you use it, the more you go to it and consume it, you'll get a better sense of, wow, the market's really changed its mind from last week, or it's really different than it was 2 or 3 weeks ago. So I think it's just something that all traders should be using. It's a great tool and highly informative.
No, 100% agree with you. It's the market's response to what the Fed is doing, and then it shows you in real time the probabilities. And when you look at this, the market's been able to respond to what the Fed chairs say. We talked about this past week or so, all of this Fed speak. Then I go to the CME Fed Watch tool and I go, how much did it really matter? What's so funny is that everybody likes to talk on social media. Well, now the Fed's going to be raising rates again, or the Fed's going to be cutting rates, and everyone says all of these different opinions, right? But the only opinion that ever matters to me is where you put your money, right? If you put your money somewhere, that's that's an actual view and opinion on the
That's right.
market. And so when you go to what's happening in the Fed fund rates and you go to what's happening in the CME Fed Watch tool, which is a response to that, and it's showing you what that probability is. This is what the market actually thinks about what they said or did. And to me, this is far better information than you're going to get from what somebody says on a media organization or in a tweet.
That's right. It's the old good efficient market hypothesis, right? It's like you're going to see way more, I think, accurate information here to Anthony, to your point, because this is where people are actually managing risk, initiating risk, or closing out their positions. And that's definitely going to be, I think, at least I agree with you. I think it's more informative than sort of the normal pundits and talking heads out there, right?
Yeah, I mean, you could take the top person in the industry and tell me whatever they think, and I'd still look at this and say,
That's
if this is
right.
81.5% chance that it's going to stay 500 to 525 basis points, that's more likely where I think the market is headed. Final thing for today, Tim. I want to go to this because this is something that CME Group has been doing for a while now. I've participated in a lot of these before, and I'm actually going to be in this challenge where I'll be doing a morning video every day on what I'm looking at for the gold market. And I think this is awesome. And actually, I would recommend it even if you are uh, an existing trader who's been doing this for a while. You guys are giving away prizes here. This is a way to go in. And I think just for even camaraderie in our industry, go in and participate in these challenges. They're a lot of fun. And you have a chance to test your strategies on a product and to see where you match against other traders. It is a simulated environment. It is free to go in and join. But I mean, Tim, just talk about why CME Group has started to do these and what you think maybe are some of the benefits for these newer traders out there to step in and to participate in some of these challenges.
I mean, absolutely. I think when we look at it, CME focuses a lot on education, right? It's important for all market participants to be educated on how the markets work, how the products work. CMEgroup.com is a great resource, Anthony, as you mentioned earlier. But sometimes you can consume all this, you can watch all the videos, you can read all the white papers, you could be an expert on sort of the ins and outs of the product. But until you start putting those fingers on the keyboard and clicking around and trading it, I feel like you get a different level of understanding if you can experiment in something like the trading challenge. It's a simulated environment, but it's moving with the markets. You can put on positions, you can learn about these contracts. Back when I was a trader, said the fastest way to learn something was figure out why you're losing money, right? Like when something you're like, I didn't expect that to happen. Why is this happening? It's a great sort of, safe and fun way to learn a lot of that stuff. And even if you're an experienced trader, come in and try out some new strategies, right?
Exactly.
Experiment with something. You got a week to play around with it. It's some really great products that have a really fun personality. When you think about the community, everyone sort of gets a little hyper competitive with each other. You can brag to your friends how you're doing in the metals trading challenge. You can probably beat Anthony too, right?
Oh,
You never know. I mean, it's
listen,
just a really fun way to learn and really get some better, like some real tangible experience about how these products behave.
it's funny. I was in the oil trading challenge maybe a couple of years ago, and I remember coming in and I started off pretty good. I was just trading it clean. I had all these winners. And then I go and see where I'm at on the board. And I'm like, man, I'm barely in the top third. I think there was like 4,000 people there. I was like 800 or
Yeah,
600. I started laughing and I'm like, I haven't even had a loser yet because
yeah,
you just never know. I mean, some people come in, they test their strategies and they're just doing things. And it's just interesting to see, and it's fun. And this one, you're actually going to have a chance to win a 1 ounce bar of gold.
that's
It's
cool.
pretty cool too. I was reading that. I was like, man, you actually get a chance to win a 1 ounce bar of gold. That's pretty cool. So that link will also be in the description if you're listening on audio. And if you follow me on social media, it will be there. And of course, you can go to cmegroup.com to learn more to find out about that. Tim, uh, thank you so much today for coming in and joining me on the show and talking about, like we said, a lot of things we've discussed in the past, but giving these newer people the futures, as we've talked about, the growth has been unbelievable. An opportunity to learn more about these different products, the choices that they have, the offerings at CME Group, the Fed Watch tool, and hopefully maybe some of them join and go and play in this gold trading challenge. So I just appreciate your time so much, Tim.
Yeah, of course. Always happy to be here. Thanks again for having me. And just really encourage everyone to go to cmegroup.com, learn more about the products, and definitely sign up for the metals trading challenge.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.